Hi everyone. Today it will be really interesting because I'm gonna show you an opportunity like never before. And before I start, keep in mind that this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, spreads, options, ETFs and others, it's always just for educational purposes. If you use Twitter or maybe some other channels, you are familiar with those funny statistics that people tend to publish from time to time about some market. For example, that this price action happened only 5 times over the past 10 years, and in 60% of the time the market did this or went up or went down, whatever. I think these statistics, this data, it's really interesting, but of course you always have to take it with a grain of salt, because there's no guarantee that the market will follow this statistical outcome even this time. Nevertheless, I'm going to show you something very interesting, because I'm going to show you a situation that happened never before. It is very rare to spot such situations, but today I found one. So, to be honest, I did not find that today. This is something we are watching for a long time. And we have been also alerting you about it on our Twitter. But the point is that it has reached the point when there is such an imbalance that happened never before. In all the historical data, we cannot find such an extreme as we can witness right now. It's not a single market. In fact, it's an intermarket strategy. Here we have the ratio between soybeans and canola. And these two markets are not picked by random, of course. They are connected fundamentally. They are both oil seeds. They can substitute one each other. And that's the reason why the fundamental relationship is also visible on the ratio. The histogram is nicely symmetrical. And most of the time the ratio oscillated around the level of 2.0. It's clearly visible on the histogram, but also on the chart, on the price chart below. And at this time, this ratio reached the level that was never recorded before. When I zoom in, you can see that the recent values were 1.17, which is an all-time low. The previous low was somewhere above 1.2, and it was from February or March 1995. So it's really it's been really a long time, and in my opinion, it's only a matter of time before this imbalance resolves. And to be honest, I know nothing about the fundamentals of these two markets. It's been a long time since I was following grains closely, but I rely purely on the statistics. There is clearly a fundamental relationship between those two markets, and in every case over the past 40 years, whenever the ratio dropped so low, it was only a matter of time before it returned to the stable level around 2.0. So I think it is a pretty good bet to think it will do this even this time. But the important thing is that this is a long-term strategy, because in the short term, it can stay at this extreme or maybe go even lower for weeks, maybe even months or a few years. But whenever the ratio was so low, it was really a short period of time before it mean reverted at least towards 1.5. So we shall see, but that's the point, that's the strategy, that's the rare opportunity, because it's very unusual to spot such an extreme. In this video, I will take a closer look at these two markets and also think about the way how to make use of this opportunity. So I will talk about potential strategies. So I think it will be interesting in the end. So I have prepared a few charts. So let's open them up. Yes, the first chart will be probably soybeans. Yes, here we go. And it's the first continuous contract on soybeans. And this is just for a first impression. And we can see that there was a strong uptrend followed by a significant correction. But in my opinion, this is not the end of the bull market. It's just a correction, and I think the bull market will continue eventually. But I think the closer look at the specific futures contract will be more interesting, more helpful. So here is the January contract on soybeans, and we can see that this falling trend line is important, and also this level around $12.50. When I'm doing this video, the price is moving somewhat lower, but you know, that's not the point. That's not really so important, because it's the relationship between those two commodities that's crucial. But this is just to get a quick quick impression of the market. Let's take a look at canola, and it looks really different, because it is just going parabolic. The price just exploded higher. And you know, I cannot do any technical analysis here. It's just going up, and it's hard to say when the uptrend will stop. But you get the idea. One of these markets is going up, one of them is going down, and the strategy or the opportunity is about mean reversion in the ratio between those two contracts, between those two commodities. But the price itself is the least interesting thing. What is intriguing is the seasonal analysis, because soybeans or the soybean market is entering a seasonally favorable period, because the seasonal curves are going up till I don't know, till spring, but the point is they are going slightly up. The statistics by month are also generally positive, with the exception of December. But when you take a look at the curves, it's more like a sideways move than a downward move. So I still consider this to be fine. And it's interesting, because when I take a look at the seasonal analysis of canola, it looks really different, because here the curves are moving slightly lower, and the statistics are not as positive as we saw for soybeans. Of course, do not expect these seasonal curves to look totally different, because, as I said, these two commodities are related. They are both oilseeds, so most of the time they are moving in one direction or similar direction. So we are interested in their spread. So even tiny but stable difference between these seasonal curves is important for the spread, as you will see in a minute. And another interesting thing is the positioning on these two markets, especially the large speculators, because on soybeans, which is the first subchart, they are approaching the zero level. So this market is pretty much oversold. Of course, you can say that it was much more oversold in the past, but that was in times when soybeans were in a bear market. So you cannot expect the positioning to oscillate in the same range when the market is in a bull market. So I do not expect this COT index to fall as much as we saw, for example, in 2019, but I do not know where it will stop. The point is that this is not a timing indicator. It's just telling us whether the market is overbought or oversold. And the positioning then serves as a fuel for the move up or down once the market turns. On the other hand, canola is outright overbought and it is approaching the 1.0 level, which means that everyone is long. This is something we saw at the end of last year. And this is really unsustainable. But like I said, it's not a timing indicator. It's just telling us that there is a lot of potential fuel for the mean reversion between those two commodities, or in the ratio between those two commodities. At last, I have the spreads, intradelivery spreads for those two markets. And I would say there is nothing really interesting. And it's not actually it's not favorable for the mean reversion because the soybean spreads are still moving down. There is no sign of strength on this market, so that's pretty bad. On the other hand, the canola spreads are still moving higher. So there is no divergence or anything. Maybe this move will continue for some time, but that would be even greater news because it would mean that the imbalance would become even greater. And I think that's all for these underlyings. And now let's talk about the way how to make use of such an opportunity. Keep in mind it's all educational. I'm not recommending anything to anybody. Actually, the only way how to make use of such an opportunity is through intermarket spreads. I have created one such spread on this chart. You can see it here, and I will explain the multiplicators to you. So you have to keep in mind that these two contracts are really different. They have different specifications. For example, the point value on soybeans is $50, while the point value on canola is only $20. So that's the reason why I multiplied the first leg, the soybeans, by 50, which means to create the value or balance the value between those two legs. And I multiplied the canola by 20, which is the point value on this market. However, canola futures are traded in Canadian dollars, not US dollars like all the commodities on all the other grains and these markets. So that's why I have to multiply this leg by 0.8, which is roughly the relationship or the value, the ratio between the US dollar and Canadian dollar. Of course, Canadian dollar is cheaper, so that's the reason why the multiplicator is lower than 1. So when I did so, I got on each side I got a quantity that I can compare to each other. That was my goal, and then I have to balance between these values because, as I said, the canola contract is much smaller compared to the soybean contract. So if I just bought one contract of soybeans and sold one contract of canola, the spread would be pretty imbalanced. Basically, I would be exposed to the soybeans, but my exposure to canola would be really low. And for that reason, I use the final multiplicator, which is this one. Basically, I multiplied the rest of the right leg by 4, which means that in a hypothetical scenario, I would sell 4 contracts of canola futures and buy 1 contract of soybean futures. There is no reason why this multiplicator has to be 4. It can be 3 because someone would prefer to have slightly lower exposure to canola. That depends if you want to be more, or if the spread wants to be more sensitive to the upside of the whole grain market or the downside of the whole grain market. For example, if I used just 3, if I multiplied the expression by 3, that would mean I would be more exposed to the upside. So if both markets would go down, it would not be ideal for me. So my goal in this case was to create a pretty balanced relationship because I'm really interested only in the relationship between those two commodities. So if when I did so, I got the same value, or roughly the same value on the right side, on the short side, and the same value on the left side, on the long side. Of course, in reality, I would buy 1 contract of soybeans and sell 4 contract of canola. So the rest of the multiplicators here are to create the so-called equity spread, which is the only correct way to analyze these spreads. It means that the y-axis is in dollars, in US dollars in this case, because I multiplied the canola by the correct multiplier for the currency exchange rate. So we can see that the spread is in a free fall. That's not surprising. And we can also see that it's quite expensive. This strategy is not suitable for small accounts or maybe even to individual traders in general. So this strategy is probably good just for hedge funds or institutional traders like prop trading firms and others. But I would say this is the disadvantage of all the intermarket strategies. They are simply too expensive. You can see that the spread can easily drop by $5,000 or $6,000 in a few days. So it's just crazy. On the other hand, these strategies also have strong advantages, and the best advantage is that they tend to be uncorrelated to the broad market, which is great because when the equities are crazy, they are under influence of the central banks and fiscal measures and so on. It's great to have uncorrelated opportunities or uncorrelated trades such as this one. So, as I said, the spread is going down, which means that soybeans, which is the long leg, soybeans is becoming cheaper compared to canola, which is obviously what we saw on those previous charts. But I will switch to the continuous price to get a better longer term idea how this spread was behaving in the past. So let's zoom out and we can see that the spread is approaching the 0 level. And whenever that happened, it was really a short-lived period when the price quickly recovered. But keep in mind, it's a continuous price, so it's an artificial time series assembled from multiple expirations over the past, I don't know, 40 years. So that's just to get a quick idea. I would also show you the seasonal curves, because I think it's really interesting that we are approaching a very strong seasonal period for this particular intermarket spread. So as I told you that those curves, those differences in the seasonal in the direction of the seasonal curves is not as significant on the standalone charts. I mean the charts for the standalone commodity. It is really visible on this spread because we are really interested in the difference between those two contracts, between those two commodities. So it's looking great from the seasonal perspective. There is no doubt about this. But don't forget what I told you minutes before, that this is medium to long-term opportunity. From the short-term perspective, the price is just falling like a knife, and it's generally not a good idea to catch such a falling knife. So from this short-term perspective, it's not as appealing. But well, it depends on everyone's strategy. And as I said, we are not recommending anything. This is just an educational analysis. And basically, that's all. And the reason is that there is no other way how to trade such an opportunity. The problem is that usually in other markets, you can use ETFs. And while there is an ETF for soybeans, there is no ETF for canola. So that's really bad, because ETFs are a great way to trade these intermarket strategies, even for smaller accounts. There's also no option market for canola, if I remember it correctly. That's also the reason why you cannot use option strategies in this case. So this intermarket spread is actually the only way how to make use of this strategy. It is risky as hell, and that's why it will be probably interesting only for institutional money managers, prop trading firms, hedge funds, but we also have many such companies among our users. So that's all for today. I hope you will find this interesting, and see you next time.